The term of the lease is fairly straightforward, but it's important to understand because it has a major impact on the lease negotiation. Lease term is simply the length of the lease, which is usually measured in months or years. Landlords generally favor a longer term for several reasons. It improves the stability of their asset. In other words, it provides uninterrupted income they can rely on. This reduces the time and costs associated with owning the building because there is significant expense and headache from tenant turnover, not only from the build-out costs and brokerage commission, but also because of downtime. In other words, time the landlord is not receiving rent because the building is vacant. A long-term lease improves their ability to get favorable financing terms from a lender. Lenders often scrutinize investment property based on the quality of the tenants and the length of their leases. Therefore, if the landlord has short-term tenants, then it's much harder to refinance at favorable terms. It also makes it harder to sell the building because a buyer will assume there's a lot of time and money required to deal with the upcoming tenant turnover. So when you're negotiating a lease, you'll find that in almost every case, the landlord is pushing for a longer term. That means the lease term can be used as a bargaining chip. If you're willing to do a longer term, you can use it to gain an advantage on other terms, for example, a better build out of the space or a lower lease rate. Even if you prefer a longer term, you don't necessarily need to reveal that immediately. You can ask for a short term and then agree to something longer as if you're making a concession. A longer term reduces the risk of rent spikes and increases stability. However, it also increases a company's financial liability and decreases its flexibility. I'll describe that a bit more. It reduces the risk of rent spikes because the rent you pay is guaranteed throughout the contract. So if you sign a 5-year lease and then 2 years later lease rates go up, it will have no effect on your rent because your rent is guaranteed for 5 years. It also means that in the same scenario, if lease rates went down, you would not be able to take advantage of that. Your company's financial liability is increased because it is contractually obligated to make the rent payments until the end of the lease term. And for that same reason, the longer term decreases flexibility. It's more difficult to move, expand, or contract when there's a long-term lease in place. A quick side note about financial liability. Currently, most office leases are categorized as operating leases, which means they are off balance sheet and rental payments are simply recorded as an expense on the income statement. The FASB, the Financial Accounting Standards Board, is implementing a major change to the accounting rules for leases. It will require that almost all leases are recorded on the balance sheet as a right-of-use asset. This change will officially go into effect January 1st, 2019, and will be retroactive for 2 years of financial statements. There's far too much information about this topic to cover right now, but to read more about it, I would recommend Googling the phrase FASB 13 accounting change.